Okay, welcome back, everybody. Hope you all had a good week. Let's go ahead and just get right into it. We'll go over a couple things that we talked about last time. As the information is getting a little more dense, we'll make sure we go over some stuff again, just in case you got any questions or want anything clarified before we move on. So last week, we just barely got started into talking about what it means to actually build an investment portfolio using ETFs and mutual funds and all sorts of things, and where we really are going to start and where your foundation should be when you're considering what your allocations are going to look like. So we talked about how I kind of group all these concepts and where we start and basically what we're pulling from in order to make selections, and kind of simplifying the process and not making it too complicated, really just making it, a little more simple, giving purpose to each investment and really deciding what it is that each investment is going to be for. So the main thing that we were talking about was using the aspect of time to choose our investments, and using the idea of how long do we have to select what it is that we're going to be invested in. Because as we know, the shorter our time horizon is, the less risk we want to take. We don't want to be in a position where tomorrow we see a giant spike in volatility and now suddenly the value of our assets have changed dramatically. Could be positive, but could be very negative. So the idea of looking at our liquidity needs, how quickly do we need to get to the assets, and how long do we have until we want to deploy them? Using that is what we're going to use to basically determine what kind of risk we're going to be taking and what sort of assets we want to choose. Because at the end of the day, it's really just a game of balancing how much risk you're taking for the purposes that we're looking for. So we talked about the law of large numbers, which is basically just saying the more data you have, the more accurately you can measure returns and risk and sort of things. So instead of being just invested in one individual stock and using its historical data, being invested in thousands of different securities, hundreds of different investments, will make it a lot easier for you to actually determine what sort of risk you're going to have moving forward, because you're going to have an average number for a lot of different securities, and then having a lot of time backed up on that as well will also give you a better idea, because those historical numbers apply to long time frames, not short time frames, not a week, not a month, not a year. So how are we using this to our advantage? Well, we're holding our riskier assets for a longer period of time. We want to make sure that if we're in an asset that has a standard deviation that's really high, that we're going up and down by tens of percents every year, that we're holding it for a longer period of time so we get closer to the measured average return that we've seen over the previous 10 to 20 years. We want to make sure that we're actually giving ourselves enough time and giving ourselves enough data for those numbers to average out in our favor. And we're going to use less risky assets for immediate needs. Obviously, if we're going to take assets soon, if we're going to take capital soon, we don't want that to be a risky asset. We don't want that to be something that fluctuates in value a lot, because, like I've mentioned, we want to make sure that that value is there for us to pull from. We want to diversify. We want to make sure that we're among many different asset types, many different asset classes, and just many different assets within those categories, so that we're not specifically exposed to any individual risk like we talked about last week. And dollar cost averaging is a simple method to where if you want to not invest all at once and you want to take a little bit of time, you can do flat investment amounts at regular intervals, and it generally tends to help you get cheaper prices, unless we just go into a straight bull market, in which case it would have been the best idea to buy all at once. But we can never know. So it's really just more of an emotional management tool than anything. In terms of returns over time, unless you're dollar cost averaging the entire time you're invested, you're not going to see much of a statistical difference. So it's really just more of a managing your own emotions about it, and not going into it thinking, okay, I'm going to put in my $100,000 and now it dropped to 90 and now I'm sad. I want to get in there maybe $10,000 at a time. And then when that drop happens, I only lose $1,000 at first. And even if I go back in again, those drops are going to be on smaller amounts of capital over time, and just kind of give me some room to breathe with the volatility of the market. We talked about time-based asset allocation, and this is just super simplified. This is kind of what classically you would think of as short term, you'd have your cash assets, intermediate term, you'd have your bonds, and long term, you'd have your stocks. Now, depending on the environment, bonds can be just as volatile as stocks can be when you have a lot of interest rate movement. So that's kind of something to keep in mind, is that yes, over super long periods of time, this could be relatively accurate, but you just want to pay attention to what kind of environment you're sitting in, because that can change things a lot. We talked about diversification, why it's really important to be among a lot of different kinds of assets. Even if it's just index funds that are really diversifying you themselves, it's important to not be exposed to single high impact risks. You don't want to be super exposed to a single company or a single sector or a single country or any of those types of things. You don't want to be overexposed to a single risk that has a high probability of really killing your overall returns and really dragging your assets down. We have all these types of risk, our diversifiable and our non-diversifiable risk. So in terms of diversifiable risk, those are the things that diversification is going to take care of for us. Any of the sort of business-specific risk, country risk, default risk, any of these things are things that we can diversify away because we can usually add enough securities that any of these individual things are not going to be consequential. For example, with default risk, if you have really high default risk, usually that's because you have a bunch of really low quality bonds in your portfolio. How do we fix that? Diversify into different credit types, have higher credit rating and lower credit rating, have a lot of different companies so you kind of pull that risk off. It's just having a lot of different things within that category that helps reduce the risk of one specific thing taking you down. And then in our non-diversifiable risk, we have all the things that we can't make go away, but we can just sort of manage how much we're exposed to it. So market risk is really the easiest one to understand here, because if I have a whole bunch of cash and I go in 100% with an S&P fund, I'm completely exposed to that market risk. That's going to be the main thing that I feel every single time. But if I only put maybe 20% of my cash into the S&P 500, you're not going to feel that as much because it's not going to affect your cash at all. Now, the one risk that you have a lot of now is purchasing power risk, because now inflation is going to start eating away at your cash. So it's kind of just like a balancing game of choosing what risks you want to be exposed to and what is going to be the thing that is the most detrimental to what you're trying to do in the short term or the long term. So now we're going to get started with a little bit more complex ideas of all of this that we've talked about, all these concepts. We're just going to dive in a little bit deeper. So we're going to get started with, some different ideas of different types of investors, different ways that you might be investing in and using these lateral and vertical integration concepts. So let's go ahead and get into that. Oh, what is happening here? Okay, so this will be practical applications for portfolio building. This will just be how can you actually take these ideas that we've talked about, these concepts that are kind of vague, kind of floating around, and how do we take it and apply it to make sure that we can actually build a useful portfolio. So in the big picture, not every portfolio requires the 3 distinct stages that we like to talk about with lateral integration, our stage 1, 2, and 3. Remember, your stage 1 being liquid assets, things that you can get to really quickly, usually what you're expecting to fund distributions or any kind of purchases or big withdrawals. Stage 2 being sort of in the middle, intermediate term growth, but you're not taking a ridiculous amount of risk. And stage 3 for all the fun stuff, get really risk on and all sorts of things. But not every portfolio has to have 3 perfectly crafted stages. A portfolio can be a stage in your overall finances. When we say portfolio, yes, most of the time we're thinking about an individual investment account, but we can really broaden our scope to look at the overall picture. A portfolio can include multiple investment accounts, a real estate portfolio. It can even include something like a pension. What we like to do is when we're looking at Social Security and pensions, if they're significant and they actually will make a pretty solid dent in the income needs of a client, we like to think, okay, well, how about we pretend that this is sort of a government bond, so to say, because it's unlikely that that cash flow is going to stop. It's a guaranteed lifetime income. And we can think, okay, so let's pretend this is a lifelong US Treasury bond or something like that. And we can go, Interesting. So there is a big chunk of our portfolio, and we can consider that as part of the stages. We can consider that stage one if we need to. And then if that person doesn't need any distributions from an investment account, we can sort of forget that for their investment account, and we can allocate it more aggressively because we know that it's not going to need to fund distributions, it's not going to need to fund lifestyle, and we can get more aggressive with it. So knowing the purpose of the account gives us the framework to build a proper portfolio. Like I'm mentioning multiple times, it's really just understanding what are we trying to do. And that's something that I notice pretty often. I sit down with clients and we have conversations where we go, so what do we want to do with it? What is the purpose? What's the objective? And they'll just kind of have a blank face. And oftentimes this will happen with people who are inheriting assets from their parents, or maybe they just have finally gotten to this stage of retirement where they, they think it's just going to fund their lifestyle, but there may also be a want to, invest it for beneficiary purposes, but it's just not a thought that's been, really thought of. And knowing exactly what that purpose is going to be really, really helps to determine how we're going to invest it. And you can earmark different parts of the portfolio for these different purposes if there's more than one. So in today's class, we're going to assume that the purpose of the portfolios is going to be funding retirement, required minimum distributions, and that sort of a thing, because it's just kind of the easiest thing to wrap your head around. And it's the most common situation that we see. Super common for there to be maybe a 401k got rolled over to an IRA, and now we're at the point where we need to take required minimum distributions, or we're just funding our lifestyle because we have no other income. So that's kind of the situation that we're going to assume that we're in this whole time, and that's what we're going to work with. So a couple examples for your standard balanced portfolio from lateral integration. We're going to talk about a couple of the different stages and a few things that you might put in them, what you might use. And again, remembering that we're assuming that this is a retirement distribution sort of angle. Of course, you could be much more aggressive than this. You could be much more conservative than this, but we're just kind of going to use that as the glasses that we're going to look through to understand these different asset types. So in stage one, imagine this is where your distributions are coming from. Imagine this is where withdrawals are coming from. When assets grow and we sell them off, we place them in here so that they can be pulled out at a later date without losing value. So this is securities that can be liquidated very quickly, little to no loss. Super non-aggressive. We're talking about cash equivalents, ultra short and short-term government bonds, just money market securities, anything that you can really get your hands on just like that really quickly and make sure that you can pull that asset out, no loss in value, except for maybe a cent on a dollar for the money market funds whenever that happens. But really just very, very low volatility assets that we can quickly get to. Nothing locked up, no limited partnerships, no super aggressive growth funds, nothing like that. Liquid, low risk, low volatility. Stage two, and this would be, sort of in that framework of 3 to 7 years, maybe even 2 to 7 years, kind of really giving a little bit of time for those numbers to catch up. So these might be longer term debt securities and just like cheap diversified index funds. So these funds would suffer a greater loss, but they would likely recover with dividends reinvested, a little bit of time for returns to catch back up. So this might be something where we're looking at intermediate term government bonds, high grade corporate debt, low cost broad market index funds, super cheap stuff, S&P funds, total market funds, stuff like that, and large cap value funds. And the reason we put large cap value in there is because we know we have those dividends, those payments out that we can use to reinvest and pad a little bit of our losses on the way down. So again, these are things that are going to suffer a little bit more with market volatility. With the intermediate term government bonds, if interest rates move a little bit, those are going to have a little bit of volatility. If interest rates start to rise, those will lose a little bit of value because they won't be paying the same interest rates that can be bought on the open market. So the value of those bonds is going to drop a little bit. High grade corporate debt obviously is going to be a little riskier because you don't have that straight up guarantee that you have with the US government, and obviously they will also be subject to interest rate risk. Low cost broad market index funds, super useful, love them, but they do have that market risk. Because you're in the equities market, you're gonna feel the shifts of the economy day to day. So you gotta understand that that's not gonna be your safest place to park cash if you wanna take it out. But if we're going to have it for a few years, it's very worth investing in these types of assets. Now, stage 3, we're looking for the long game here. This is where we don't even want to think about touching it for several years. We're really just giving ourselves a lot of time. So these are securities that are held for long-term investor objectives and goals. Lots of growth, really hoping that we got lots of time for those average numbers to kick in and give us those returns that we're looking for. This is when we get the most aggressive, growth-oriented. We're not thinking about dividends too much. We're not thinking too much about interest, but we will get into some riskier bonds. And we're just really trying to get the most capital appreciation over time. So this would be things like growth funds, long-term bonds. And we put long-term bonds in here just because of their inherently high interest rate risk. If you've got like a 10 to 20 or 30-year bond, if interest rates go up by a little bit, that really hurts the value of long-term bonds because you're locked in at that lower interest rate when somebody else could just step over and buy the much higher interest rate with the same dollars. So that value is going to hurt because of how long you're locked in. Junk bond funds are also interesting for this because you can actually see a decent amount of capital appreciation with junk bond funds when it comes to interest rate risk and all those sorts of things, but they just don't have a lot of value at first because you're not very certain that they're going to pay out because there's a much higher default risk. But as it gets more and more certain as we get closer to the maturity of those bonds, they might become a little bit more interesting because those high interest rates, you're really close to that maturity. So it's much more likely than you're going to get all of that return back. Speculative investments go great here as well. New sectors, individual stocks, or just anything that you really have your eye on but you're not really sure about. This is a great place to put that because we got plenty of time. And especially if we have things like stage 2 paying out dividends and interest and things that we can reinvest, a lot of these losses can be padded back and added to with interest and dividends in order to build it back up and give us even more of a base to jump off of. So investor profiles is another really important thing. Each investor will have vastly different goals and desires. A lot of them are going to be very similar because, as we mentioned, a very common example is just retirement account distributions. But each person is going to have a very different approach to how they feel about investing in the market. You'll have investors that have tons of money, but their main concern is, I don't want to see that value fluctuate very much. They just want stability, interest coming off, dividend payments, and they want to feel secure. You might have people that are much more aggressive and they just want to get all in. They want to see the growth. They want to see things happen over time. But for each of these different investors, there will be a different asset allocation that makes the most sense for them. Mathematically, obviously, there's always the best answer, but the best mathematical answer is not always the best answer for the investor. And the reason for that is not because there's going to be some better way to do it for them, or it just comes down to emotions and it comes down to feeling. Because one of the things that we really like to make sure that people understand and we talk to about our clients is, yes, we can always invest it in a way that mathematically will put you in the best scenario in the future. But how much can you withstand the volatility going into that? Or how much can you withstand missing out on the growth going into that? How are you going to feel when these different things happen? And part of the things that we do sometimes is kind of try and read that from people, because a lot of people will actually not know themselves. It's pretty common for people to either overextend what they think they can handle and risk, and then you invest it for them, and they go, what happened? My portfolio is falling. And I go, I know, because we bought all S&P 500 funds. I don't really know what you expected, but you kind of got to read into yourself and understand, like, how is that going to feel? Like, if you really took the volatility that the assets in your portfolio have, apply that worst case scenario. Really look at what is the worst day going to feel like and how much would that rattle you? Because if it rattles you so much that you change what you're doing, that you change your investment allocation, that you change your plan, you're going to completely throw it off and you might not ever get to that goal that was pretty certain if you had just stayed course. So that's why it's really important to understand your investor profile and really just understand how it's going to make you feel when these different things happen. So this will influence very strongly our choices for funds in each allocation. Obviously, there will be some math that goes into it that we just have to bend to, but we're going to bias towards different things depending on the investor profile. So let's look at a couple different examples that we might have. Let's go forward. Get rid of this. That's not what I wanted. Apologies.
2008. You have friends that got out of the market.
That's not what I wanted.
I've seen people get out at the bottom of 08, 09, right? 09, let's call it 08. They bailed out of the market, had a pretty big loss, and then the market, it took a long time, but by the time the market came back, they were out double the time they totally sell. So that's why I think older investors are better investors, because we've seen the ups and downs. Well, the good thing about too old is you might not need it, so now you're planning for grandkids.
So to start off with, we'll just start at the bottom, really. The very conservative investor, somebody who wants just minimal volatility, has very significant immediate cash needs possibly, and just doesn't really have a need for growth. You can kind of imagine like giant retirement account, plenty to pay for all the expenses, maybe doesn't have beneficiaries that it needs to go to, and just has more than enough for themselves. So this kind of person is really they're not going to need a lot of stocks. They're really just going to need stuff that provides income, because what we want to do is maintain the value and just pay out a little bit of interest, pay out some dividends for our time there. So this kind of person might use these sorts of allocations for their portfolio. Stage one, ultra short, super short-term US government securities, money market funds, CDs, just like really, really liquid stuff. And this could be a really significant portion of their portfolio. If they don't need any growth, if they don't really need much of anything at all, stage one might be fairly significant, because they just want to see it sit there, earn a little bit of interest, and pay out over time. Stage two will probably be a little bit longer US government securities, adjustable rate mortgage funds, different types of high grade debt, government debt that we'll use that has a really strong credit rating, and it's just, we're not worried about default risk or market risk or any of those sorts of things. We might have a little bit of interest rate risk, but if we're locked into these for the long term, that's not going to be so much of an issue for us. In stage three, which would generally be where we see a lot of growth, might have our longer term government securities, investment grade corporate debt, things that have a little bit of interest rate volatility, but are not going to have, 15, 20, 25% standard deviation up and down every year. Might have some utility sector funds or other sector funds that pay strong dividends and income, things that aren't quite as volatile as just super high growth stock funds. You might have balance funds. There's a couple different balance funds that kind of create their own asset allocation of stocks and bonds within them and manage it for you. So that might be what you place instead of growth assets, is something a little bit more balanced, where sure, you get a little bit of that equities, but you're not going full risk on with all of that. So obviously, if we were to create a portfolio like this and compare it to something like the S&P 500, we'd be trailing real far behind. But that's not to say that we're doing poorly. That just means that we're trying to serve a different objective, because we're not looking to grow with this portfolio. We're just looking to maintain value, provide income, and provide stability. And so this portfolio would do a pretty decent job of that, depending on, how strongly we're allocated to each section. And then the most common type of investor, in my experience, is the moderate investor. Middle of the road, has a little bit of immediate cash needs, might have required minimum distributions coming out, wants strong yield, wants to see those nice dividends, and wants a little bit of growth for the future. They want to know that their portfolio is going to keep up with inflation. They want to know that things are going to move in the direction that they want, that they're wanting to see those values increase over time. So this is kind of a person where your allocations could go anywhere from 40% stocks, 60% bonds, to 60% stocks, 40% bonds, anywhere in between, or pushing those boundaries a little bit more. This is just really where, when you're invested, you want to know that when the stock market crashes, you're not following it all the way down to the floor, but you know that when it's growing over time, you're able to participate in that, and that you're feeling the growth over time. So this would be stage one. Again, those money market mutual funds, maybe some adjustable rate US government securities, short-term government securities. We're getting a little bit longer term because probably the money market mutual funds are going to handle our distributions, and we might have some of these other things paying higher yields, higher interest rates in order to fund that position a little bit more. When we move over to stage two, that's where our longer term bond funds are going to be. We're not going to have a huge amount of these depending on the environment because we don't want that high interest rate risk, but we're going to have a lot of low cost index funds, total market, S&P, NASDAQ, all sorts of things, value and dividend focused funds, really great options for that. There's a lot of really, really good high dividend funds that we like to use a lot. You know, Vanguard has a good one, Schwab has a good one, and I forget, I think one of them is iShares is one I like a lot, but just really looking for those companies that they're here, they're going to stay, and they're going to pay lots of dividends, but they're still going to grow with the economy. We're not just going to completely fall behind. We're still going to see those assets increase because inflation is going to affect them. The economy growing is going to affect them and all sorts of things. As we move on over to stage three, we're looking at our high yield corporate bond funds where we're taking a little bit of extra risk to up that yield, get probably closer to 6 or 7% rather than 3, 4, and 5. You have your longer term US government securities, which right now still don't look that appealing. The yields are still not amazing on intermediate to long term government securities. It still is pretty much worth it to hang out in short term government bonds and then go for maybe high yield funds for that sort of idea. But this is where you also have maybe some sector index funds. You might have a lot of tech funds in here. You might have really any other industry that looks interesting if financials are down, or utilities, energy, anything like that. And equity growth funds, just those funds that are really focused on picking those companies that have a lot of market share to capitalize on and aren't necessarily paying out dividends and value. So again, this is really just that middle ground, really kind of most standard portfolio that I think gets allocated most of the time, because you're getting a little bit of everything. You're getting like the good of all the different things that exist in the market and in the portfolio building process. You're getting a nice strong yield with some dividend funds, high yield bond funds, short-term government bond funds, all sorts of things. You're getting a little bit of growth from those dividend and value funds, and you're getting growth from the sector funds, index funds or sector index funds, equity growth funds, all sorts of things. You're really just getting that full picture, and you can move around very well. You can be nimble with a lot of these investments. It's just a really good choice for a lot of people.
About equity growth, does that equate to like capital gains, like it appreciates?
Yes, exactly.
Versus like
Mhm.
So like how does tax efficiency relate to these types of stages?
Yeah, so if we're looking at a taxable account, for the most part, if you're looking to be really tax efficient, dividend stocks are just not really something that you're going to be too interested in. We'll be looking at treasuries for state tax-free income, municipal bonds for federal tax-free income. So yeah, again, that's kind of another one of those reasons why it's really important to understand where it sits specifically, because all of this is super, this is broad-based. Retirement accounts is kind of generally what we're thinking of. But that's kind of where you get into it, where you can take these ideas, and if you put this down and you just think of, okay, where do each of these categories conflict with what I'm trying to do? It's pretty easy to make some decent swaps there. So I would be probably more focused on, I'd be very interested in treasuries, municipal bonds, and stuff like that, and then just maybe allocating a little bit more of that equity to the growth fund so we don't get those payouts to pay taxes on, all sorts of things like that.
Like Nash said, overall picture, you might utilize the retirement funds for the dividend paying stocks and time taxable stuff because it's inside of this further. And then outside of that, you recommend index funds or ETFs. And ETFs usually, right, they're not known for distributing.
Well, it depends. So if we're talking about growth funds, yes, absolutely. But if we're talking about value funds and dividend funds, they're still going to pay out those.
They're not designed to pay out.
Right.
They don't have to. So in retirement plan, high dividends outside.
Yeah, and for the most part, I'm almost always using ETFs for all of my choices, mostly because sometimes I can run into conflicts with Mutual funds, they can be high fees. Sometimes they're just not approved with our broker dealer, but ETFs are just really easy to pick from. There's so many options now. They're more tax efficient in taxable accounts. And but the one time that I will use mutual funds is because mutual funds are the only thing that you can do systematic payment plans out of. You can't do a systematic periodic payment from an ETF. It has to be out of a mutual fund. So that would be like if you had your required minimum distributions and you just wanted it to automatically come out as soon as it's calculated or on a monthly basis, and you want it to come out of a particular position, that would have to be a mutual fund. So that's just a little interesting thing to think about. So the next stage up is we're talking about the aggressive investor. We're talking about somebody who doesn't have cash needs, they don't have withdrawals that are going to be happening anytime soon, and they really want strong growth over a long period of time. And this person is willing to withstand a lot of volatility. They want to feel it all, they want to see it all, they want to buy in when it's low, they want to see it rise when it goes high. This would be younger people. This would be people like me, people who have a lot of time before like it even makes any sense to touch assets. Like when you aren't even close to the age where you can pull it out without penalty, all sorts of different things. So really good for your younger beneficiaries, or if you have trusts that are designed for the benefit of younger people, this is where this will come into play. But this is where stage one, you might have some income funds, but you're not going to have those super stable, low volatility. You might get into high yield bond funds and even derivative income funds, things that maybe sell options on different stocks or use different alternative methods to generate yield. In stage two, you're going to have a lot of these equity growth funds, low cost index funds, just because those tend to give the most efficient returns over time when you're not paying very much and you're just getting into the broad market. You're going to have stage two is really going to be the big, huge portion of a portfolio like this. Stage one will usually be quite small, maybe 10%, 20% if you really feel like it. But at that point, it's better to go into the index funds because you'll give up a lot of long-term growth depending. Stage three is where we'll see the most volatile stuff that you'll ever see in the portfolios is going to happen in stage three of an aggressive investor. This is where you're going to see those small, mid-cap growth funds, individual stocks, limited partnerships, REITs, anything that just is way too risky for any other purpose. It's going to go right here. So this is really where you're just looking for these funds don't get touched. You don't change, like you don't sell out of things. You just buy in, you add more money. You're really trying to just grow this portfolio as much as possible over time. And the only reason that we would really have these income funds over here, high yield bonds and derivative income, is just to give us something that does shoot off a little bit of yield that we could take and we could invest into the other things. Like if we have individual stock that really just crashes like crazy, but we still believe in it, maybe we have a little bit of income shooting off from the derivative funds and the high yield bond funds that we can reinvest back in at lower cost and potentially give us an even better chance of feeling that growth on the way up. So let's go over those things a little bit again before we get into the next topic. Stage one, we're generally providing instant cash, stability of assets. Obviously, as you saw, depending on the investor profile, depending on the purpose of the account, these things can change, but we're just talking in generalities, mostly for moderates, retirement accounts and stuff like that. Generally, stage one is going to be where you would draw your assets from. If you're going to take money out, that's where it's coming from. You're not pulling it from your stock funds. You're not pulling it from sector funds, individual stocks, anything like that. You're going to want to pull it from these cash assets because you want it to be stable and you want it to come out without significant loss. Stage two, designed for intermediate liquidity. Yes, you could get there if you needed to, but you understand that you're taking on a little bit of risk and you might feel a little bit of loss when you go to sell. You have an intermediate term horizon. You have a little bit of time that you want to submit to. You want to allow the returns to average out and give us those returns to really build our portfolio a little bit. And finally, in stage three, we're designed for those super long-term results while experiencing short-term volatility. Understanding that 1 year, 2 year, 3 year, even 4 or 5 years could be poor performance times. We could just feel that real strong drag. But we understand that over the long term, 10 years, 20 years, however long it's going to be, We're going to wait for that to happen, and we're going to wait for those returns to catch us back up, dividends to get reinvested, and for the economy to turn back around in our favor. So moving on to the next thing, we're going to talk about diversification or vertical integration. So this is really just the practical version of all those different things that we talked about, all those different risks, those super individual risks that we want to make sure that we're not exposed to. This is where we're going to take care of it. We kind of call it our bottom-up allocations, because we're going to start down here at our base and we're going to step up into smaller and more targeted things. So in level 1, really just that big section down here, which is going to be your biggest positions. It's going to be lowest cost. The base of our portfolio has the purpose of participating in overall market trends. We're not looking to do more than the market. We're not looking to do anything special. We're just going to participate in what's happening. So for the most part, we're looking for same as the market returns, same as the market performance, whether they're stocks or bonds. We're just looking to get into a nice blend of what's out there and not try and do anything else. So these will be funds that have very little unsystematic risk. Those diversifiable risks, if you remember those financial, business, default, all sorts of things like that, these funds are going to be the type of things that eliminate those risks for the most part. And that's why they are our biggest positions. It's that and low cost. So those are the two things that we really want to be focused on here. And to be honest, you could just stop at this level and you don't need to add extra on top of this. If you just had your base level, your low cost, super well diversified funds, there's not much more that you need to do on top of that. We just like to go into other things for more control, more intimate details, and have a little bit more diversified of a portfolio. But ideally, these funds would take care of diversification for you. They would take care of eliminating those unsystematic risks and making sure that you're not overexposed to any one thing in particular. So this is going to be things like broad-based low-cost index funds. Total market funds make a lot of sense here. Bond indices, but then making sure that your duration risk is not too high. So short-term bond indices, treasury bill indices, stuff like that. International, global, all sorts of big, broad, lots of stocks in there, lots of things in there, just these index funds that cover huge bases. And we want low cost. We don't want to be paying 50 basis points. We don't want to be paying 75 basis points just to be participating in an index. This is where we want the super cheap stuff. Vanguard has things like VOO is their S&P 500 fund, really inexpensive. VTI is their total market index fund, super inexpensive. Fidelity has S&P funds and NASDAQ funds, total market, paying next to nothing. And in fact, if you go to Fidelity, they have some zero cost. So if you have your assets at Fidelity, there are some funds you can pay actually nothing for. Yeah.
Zero cost and the others like VTI.
So usually, depending on what they follow, there shouldn't be much of a difference at all. But the reason that they're doing that is to get you in there and then sell you on their other more expensive funds. And also, they make the admin fees on all your different accounts and all that kind of stuff. So anything that you're paying for is going to go to Fidelity, but they want to bring you in with those zero cost funds so that you start to buy their other products. It's what we call a loss leader. So that's good.
Okay. Go to Fidelity, you get free funds, which is low cost, but if you start buying their funds, you don't watch the expense ratio, they can go up. And Schwab is the same way. Yeah, but if you get your whole legacy funds, they could get that.
So the zero cost fund can go up.
Or they could legally, but they wouldn't. But if you buy that fund and all of a sudden you think, well, I need a different fund here, another Fidelity fund, they might be higher management. You want to be careful that if you buy all Fidelity or Schwab, just make sure you're aware of the expense ratio. You could go to Vanguard and probably never even look at it, all the same costs. But Schwab and Fidelity are good. Same with iShares or anybody else. Just keep an eye on the cost, and if they're doing something that you can't, you can want to pay for it, or have to pay a higher. But it's got to be fun.
So other stuff that can fit into this category is low cost factor funds, or really just things that are very similar to index funds, but they might be a little bit more picky with how they're choosing the investments. So short-term bonds, value stocks, all sorts of different things. A lot of these will still be your index funds, but they might have very slight little constraints on how they're going to choose those, sort of quantitative things and stuff like that. But at the end of the day, we want low cost. In my opinion, you want to be paying less than 15 basis points or 15% of a percent. I don't want to be paying anything more than that for these low cost funds. I might step up to 17, maybe up to 20, but there's really no purpose in paying more than that on these because there are so many super inexpensive options out there, like VTI, like, well, we'll show a couple of them in a second, but there's just a lot of really inexpensive options out there. And if you use something like Morningstar, it's very easy to sort by expense ratio and really just putting on a bunch of different things that we can use. In fact, maybe at the end of the class today, we can hop on Morningstar and I can show you how to look at some of those things. So a couple examples of what you might use in this section. And you'll notice how low all of these fees are. You're paying next to nothing for all of these funds because they're doing next to nothing. They're not doing a whole lot. They're just giving you the basket and you're just buying into it and you're doing the work of choosing what works for you. So up at the top is one that's been a favorite for a while. FSKAX is a total market stock mutual fund from Fidelity with a fee of 0.015%. or 1.5 basis points. That's a fee you won't even, you barely even acknowledge that it's there. It's so low. And that's close enough to no fee. I would love to see that as a large position in a portfolio because it just really drives the overall cost of the portfolio way down. And you'll see that it has 3,850 individual stocks. So all of those diversifiable risks, not even a concern. All we're worried about here is market risk, how much of that overall market volatility that we're feeling. So again, total market mutual fund, 1.5 basis points, fantastic choice because it's so cheap, you're just going to feel the overall market. Now, because it's not equally weighted and it's still market cap weighted, it's going to have really similar performance to something like an S&P fund. So the next one that we see below that is a Vanguard S&P 500 ETF, ticker VOO, with a management fee of 0.03% or 3 basis points, which is double the fee of the Fidelity, but at the same time, it's still so low that it's barely consequential at all. The dividends paid out from that will cover it by 50 times probably. But it has 503 individual stocks in it. That's because the S&P 500 has now been a little bit more than 500 stocks. But you'll notice that if you compare the charts of those top two investments, they're really similar. So that kind of gives you an idea of if you want an S&P 500 fund or you want a total market fund, if they're both market cap weighted, it doesn't really matter too much which one you pick, just pick the cheaper one. Yeah.
Different stocks and both.
Yes.
Same.
Yeah, still the same, very similar performance. And that is mostly due to like the top 20 stocks in the S&P 500 drive 95+% of all the returns in all of those stocks. And again, it's because it's market cap weighted. So it's because of how big that company is determining how big of an allocation it has in the fund. So if you have the S&P 500 and the total market next to each other, Apple will still be one of the largest, if not the largest position in both of them and derive just such significant amounts of the returns.
Yeah, both same.
Yeah, they're pretty much exactly the same. You could argue that there's a little bit better diversification with the total market, but then at the same time, because it's market cap weighted, all that diversification is such teeny tiny little values that it's not adding a lot. There might be a different argument for if it was equally weighted. If we said that all the positions were the same size, that might reduce our risk from technology or any of the particular Apple. So that could be an argument for a different equally weighted total market index fund. But I haven't looked at the performance of those recently. That's a little bit of research I want to do, see what that provides for us. But moving on from that, now that we're out of those equities, now we've got two bond funds. The first is a short-term US Treasury ETF from Schwab with a fee of, again, 3 basis points and has close to 100 individual notes in there. Now, because these are Treasury bills, Treasury funds, or Treasury bonds, we're not really too worried about default risk or credit rating. So we're really just looking at getting that short-term yield. So this is a great place that you could park money that you just want to earn a little bit of yield on. You're not looking for growth. You just want to get some interest for your time. That's a really good option. I think another one is SGOV. That's one I've been using, but it has a slightly higher expense ratio, but I believe the yield is also a little higher on that as well. So it really just depends what you're looking for, but I would always base this towards that lower cost. Yes. Yeah, you should be able to buy in Vanguard. As long as you have a brokerage account, you should be able to buy from pretty much anybody. What you might want to pay attention to is what's called the ticket charge. So that might be different depending on which you buy from. So I know for us, when we're buying in an account, if we buy a Fidelity fund, any Fidelity fund, there's no ticket charge. We don't pay anything to trade that because our clearing firm is with Fidelity. So there's a benefit for us to use Fidelity funds because it's within the family. You know, all of it, all the money stays there. But if we go to buy something else, some other ETF, we're going to pay $7 every time we do a trade. So depending on how big that trade is, that could be substantial. But if we buy a Vanguard mutual fund, it's $17. So it's that $7 plus an extra 10. So that's one of the things you want to pay attention to is just kind of like go pretend you're going to buy a share and see what costs come out to, and then compare some different things, because always buying the same company that you're at will pretty much always be the cheapest thing. Yeah, you should. Basically, so for me, when I go to do it, if I go to place a trade, I say I want to buy this ticker, I want to buy this many, and then it will give me sort of a verification before I submit the trade, and it'll say it's this plus this charge. It really depends where you're at, but I would just take a look around. You could even call their line and ask what does it cost to trade different things. That might be a useful thing to do.
That's like directly to like the company Vanguard.
Yeah.
So like I'm working with Citibank. Will I be able to see those kinds of expenses?
You should be able to see that because it's required that that's disclosed to you so that you know what you're paying. So it should be on something like, you should get some sort of confirmation for trades, like when trades are placed. So you should be able to see it in that, or if you're going to place a trade, they should be showing it to you up front before you're placing that. But it really depends on the institution. I would get in contact with somebody from that and just make sure that you can get them to, give you all that information. So another one that we've got is a total bond market index fund from Vanguard, which has a fee of 5 basis points and over 17,750 individual bonds. So we're not too worried that any individual bond is going to go up in flames. However, one thing to understand about total bond market index funds is because you're in all the bonds, that means you're in all the different lengths of maturity. So you're going to have those short-term bonds, but you're also going to have those 10, 20, and 30-year bonds stretching out your duration risk. So that means you're going to be a little bit susceptible to interest rate risk. So for me, I don't usually like using total bond market index funds because it doesn't allow me to position myself for interest rate changes. It doesn't allow me to reduce my risk of interest rates going up and now the value of my bonds dropping. So if I'm going to have all the different maturities, I would prefer to have separate index funds for each length. Short term, I don't want to have something for. Intermediate term, I want to have something for. Long term, extended term, I want to break it up. Because for me, if I sense that something's happening in the economy that's going to, whether interest rates are going to be going up or down, if it's volatile, I don't want those long-term investments. I don't want those long-term bonds. Because if rates start to spike up like they did a little bit ago, long-term bonds dropped as much as 30, 40%. And they don't really recover because interest rates have to drop so far back down for those values to come back up. So personally, I don't like total bond market index funds. Sometimes if you're in like a savings plus plan, that's really all you've got to choose from. But for the most part, I don't really like to use total bond market index funds because my hand is forced. I have to be exposed to all these different lengths of maturity. I'd prefer to break it up into individual pieces so that I can manage it myself. And we just bias towards short term anyway because of the lower volatility, especially now when rates are pretty good.
And the risk bonds, what's the benefits?
Benefits usually is higher yields, but right now that's still not really the case. Like the rates, in fact, I have a yield curve pulled up here. Let me put this up. So here we can see the yield curve of different treasury bonds. And you can see that all the way over here we've got our 1 month, 2 month, 1 year, and you can still see that these 1 month treasuries are still paying like almost 5%. But you get all the way down to 3 years, 5 years, 7 years, it's still less than 4. So it's still like it's hard to argue for long-term bonds even now because the rates are still not great. So it really just kind of, at this point, it's hard to recommend them, period. We still just haven't really felt that. The only time that I'm using them is not for the yield, but I'm using them for if interest rates start to drop, that I can get a little bit of capital gains on that and just make a little bit of money from the values increasing, just relative. Not that they're going to have any great yield, but just knowing that if rates start to fall relatively, those bonds will start to increase in value so I can capitalize on that a little bit. Yeah.
That taxation capital gains or your non-tax rate?
So for the value of the bonds going up, yeah, that'll be capital gains because that'll basically be, if you're holding the bond, the interest will obviously be taxed at ordinary income or whatever it's going to be depending on which kind of bond it is. But if the value of it increases, that difference is going to be capital gains. Yeah.
Evidence will be your tax.
Yes. Yeah. And then obviously if you have treasuries, you're not going to pay state. If you have municipals, you're not going to pay Fed, all that kind of fun stuff. Okay, so let's hop back in. So level two, now we're moving up. And remember that as we move up in the portfolio, as we move up to more specific, our positions are getting smaller. So we're not going to have nearly the same size of positions here because we're going to start paying higher fees. We're going to have more diversifiable risk. So we're actually getting less diversified with these positions because we're seeking opportunities. We're seeking places to get higher yields or just bias ourselves towards other things now that we've taken care of diversification, now that our base has been established. Now we're kind of pushing ourselves to see how we can optimize or just get a little bit more out of our portfolio. So the midsection has the purpose of generating exposure to more targeted investments in both equity and bond categories. So we're looking for opportunities in depressed sectors and more tactical investing strategies. You might think factor funds, sectors, maybe some more actively managed things, just stuff that is a little bit more particular and isn't just get me one of everything and I'll close my eyes and wake up in 10 years. Factor funds are going to be something where you basically think of it as you have an index that you're going to follow. Let's say it's the S&P 500, but we want to go, I want to add one more factor that I'm going to consider for. So maybe I say I want a price earnings ratio below X or whatever it is. And you go, okay, now out of that index, if I apply this factor, which of these am I going to buy? And now it's going to be this. So it's not the entire list, but when you apply that extra factor, now you're going to choose a more picky list of things based on something that you determine is valuable in whatever sense. So that's
Prepackaged funds, or are you doing that as a?
That's prepackaged. So there's plenty of prepackaged funds that do this. Yeah. So you think of like Fidelity has what they call their enhanced funds. So they'll have like an enhanced large cap growth. Well, they'll use other different quantitative or whatever other methodologies they use to look at a growth index and then go, how are we going to narrow this down to what we think are going to be the most beneficial? Yes. Not necessarily. They can have some advantages and sometimes they do perform better. But one of the things that I notice a lot of the times is when you get these strategies that are supposed to be enhanced or better or factor, whatever, they usually do best with certain economic environments. So usually a lot of these funds will not necessarily do better than the S&P 500 over time, but there are little portions where like real points in time where they can do really well. Or what can happen is like I was talking about a few classes ago, risk-adjusted returns. So if you might have a way that they take investments out of an index and they go, okay, what we're doing is we're taking out these ones that have the ultra high risk. So we're taking out these ones that seem to perform really poorly, but are just really volatile. So we're kind of narrowing down our choices a little bit into this collection that might get you a little less return, but it might be a lot less risk. So you might not get the same numerical return, but if you look at how much risk you're taking on, you might proportionally be doing quote unquote better. And that's what I like to use those for. It's not that I think I'm going to get better returns, not that I think I'm going to get more money, but possibly the overall volatility of the portfolio could be brought down a little bit while getting most of the returns that the S&P is going to give me. That's really what these more interesting investments are for. Because if you want the best numbers, buy an S&P 500 fund, close your eyes, turn around, plug your ears, don't listen to anybody, and just come back at the end of your time horizon and you'll be fine.
We ran into that in 2020, the pandemic and all that stuff. Had a factor fund that was low volatility, and it had a variety of stocks in there that had history of less volatility, energy, utility, high dividends, lower volatility. Pandemic hit. The high dividend fund dropped more than the growth fund because they were sold based on dividends. Well, it's out of business and shuts down for a while. We can't milk the cows and get the harvest in. The conservative high risk stock dropped more than technology. We were quite okay, fine. We'll wait it out. Well, this great little low volatile acquisition funds reallocates it. So the funds that drop the most that you're thinking, well, they'll be back. They reallocated out of this at a loss. Your opportunity. Be careful, you gotta know what they're doing. Is it worth it? The total stock market index fund versus an equally weighted, you're giving up the upside on the equal weighted, and you will be happy when the market falls. But there's always strengths.
So not exactly, they change it, because then
Depending on funds, some funds wouldn't reallocate, but this particular one did. So that was distressing. So it wasn't their fault. They did what they promised to do. Reallocated into the least volatile. But if you have an unusual circumstance, like utilities, they're usually, they're not as volatile, but they are just as much as the market. Gas goes up 50% in the last year. Utility, right? And then there's a whole story behind that, but I wouldn't go buy utilities right now.
Yeah. So again, we're looking for those opportunities in depressed sectors. Like if utilities was down right now, that might be something that we buy, but it's not. The only thing that I think is lagging at this point is real estate and then energy on the short term, not so much on the long term, but short term a little bit. We're looking for higher yields in our bonds, whether it's via corporate debt, longer term government securities, or high yield, or whatever it is. This is where we're looking to really get some of that extra yield so that we can use it later, because hopefully we would have already got plenty of short-term, high-grade, super good, like stable assets to generate yield below this. And now we're looking for some more interesting stuff. So a couple examples that we can look at. Here's 3 ETFs that, these are 3 choice ones that I like to use. FELG is one that I was just talking about. It's Fidelity's large cap growth. It's like an enhanced large cap growth ETF with a fee of 0.18%, a little bit more expensive than our funds from before. It's not negligible. It's there, but it's still low. It's still below that 20 basis points that I like to get under. And it uses quantitative analysis to help in choosing stocks for growth. So this is going to be one of those factor funds. This is going to be one of those funds that's looking at a growth index, that's looking at some sort of index, and it's using their own ideas of what metrics they think help choose better companies, and they're going to apply that to these indices to help narrow down their choices in order to hopefully get better risk-adjusted returns over time. And this one's actually performed pretty decently. Compared to its category and other funds like it, it does really well. Obviously, if we compare it to the S&P is probably going to blow it out of the water, but it's again one of those things where you might be getting lower risk for a decent chunk of that return that you would get somewhere else. So that's one to consider. HDV is a high dividend stock ETF from iShares. One of those ones still super inexpensive, only 8 basis points. But the idea is that it's really just giving you stocks that are paying out decent dividends. Now, high dividend sounds like, oh, I'm going to be getting all this interest and dividends, but it's like 2 to 3%. It's not that high of a number, but keep in mind that you're having that along with the capital gain prospects, the idea that the stock could grow over time, and you're getting the dividends paid out. So we like to use those dividends to reinvest back in or help us buy other growth securities alongside that. There's a couple other ones. I know Vanguard has one. I think it's VYM. And then I'm trying to remember, SCHD is one from Schwab. A lot of different stuff. But again, you just look at those different things, see what fund you like the best, and default to the low cost. So one thing that I like to do is kind of balance. I like to look at, especially if I'm looking at a high dividend, I'll look at, okay, what's the dividend yield? How much are they paying over the last 12 months? And what's the expense ratio? Because the cheapest fund might not always have the best dividend yield. It might be a little bit more biased in a different direction. So I kind of like to look at the two things put together. So if I have a fund that's paying 2.5% and it's only charging me 1 basis point versus one that's paying 3, and maybe it's charging me 20, the 3 is still going to be worthwhile because that spread is still accounted for. So it's just kind of looking at all these things together. Low cost is usually the best, but sometimes there's a fund that does a little better just because the allocation is slightly different, or maybe at that time a certain company is paying out really good dividends. But look at more than just super short-term data. Look at long-term data, look at how they do what they do, how they're choosing those investments. That'll be very important.
High dividend stocks tend to be done growing. And now they're kicking out more income to you, that you buy the shares and satisfy you as an investor. If there were one of these Elon Musk companies, they don't care about what you do. They're going to reinvest everything and run away and try to get all the things. So high dividend funds are great, but they're not designed to give you all the upside. But they tend to be a little bit.
So another one that we've got here is a sector fund. We were just talking about utilities. FUTY is a utilities index ETF from Fidelity, super low cost, 8.4 basis points. And really, we're just getting that exposure to a certain sector of the market. And usually we want to do that when we see that a certain sector is underperforming compared to everything else. Because a lot of sectors are very cyclical. They'll come up and they'll go down, and they'll come up and they'll go down, just depending on what's happening economically. So we kind of like to use that to position ourselves where our overall returns are not going to look vastly different, but we kind of have this mobility. So where if we have different sector funds, we have different positions to where, say I need to generate cash for something, and I'm looking at a bunch of different sector funds. I've got energy, technology, utilities, financials, industrials, and I think, okay, what's been up a lot recently? Let's take from that, sell off that position, fund my cash, and if I have anything left over, I'll spread it around. It just gives us that mobility to choose where to come out of, choose what to stop participating in, and move around. I like that control. You might not have a desire for that. You might just want to be in those total market index funds, and you could stop at level 1, the base, get the cheap exposure, and just not worry about the rest. But I like having that control. I like being able to have that mobility to move back and forth and respond to things that happen. If something economically just blows one of my positions up and it goes flying into the sky, and I get to take advantage of that and now use it to enhance my portfolio in some other way, I just like to have that control, be able to put my hand on every dollar, on everything that is moving, whether it's strongly up or strongly down.
Utilities are moving towards technology.
It's possible that they could be, but yeah, I'm not sure. I'm not much of an economist. So another option that we have here is a mid-cap value stock ETF from iShares, ticker IWS. This is the most expensive on this list here, with an expense ratio of 0.23%. Now, still overall, that's a pretty low expense ratio when we're talking about funds in general, but it is higher compared to all the things that we've been looking at. And this is really just giving us exposure to those smaller companies. Not quite small caps, not startups, not micro caps, not the tiniest ones, but maybe companies that are starting to get a little bit of momentum. They're finally starting to get themselves into market share, but they just haven't quite made it all the way to large cap. So that you might think that those are the better buy than small caps, Really just kind of depends. I like to have a little bit of everything, a little bit of small caps, mid caps, large caps, stay diversified. But that's a good option for mid caps. So getting to level 3, this is where we can get really interesting, get really fun, and just do sorts of things that you wouldn't normally do. So the very top of the portfolio has the purpose of taking a higher risk than we would take overall in seeking opportunities, or benefit from tenured management experience, benefit from fund managers that really just have been doing what they're doing for a long time, and they're really good at it, and we're willing to let them do the work for us. We're willing to pay higher fees for very particular strategies or management teams. And the reason that we're willing to pay these higher fees is because, remember, as we get higher up, these positions get smaller and smaller. So we're not putting a lot of capital towards these. We're not giving up a lot of returns. We're not spending a lot of money on these management strategies. We're willing to pay the higher fees because they're small, and because if we step back to base 1, we have these giant low-cost positions, big total market fund at a basis point and a half, and we just have this little 3 to 5% position in these little high-cost funds. And we're not worried about it because we have those other positions that are biasing our costs really strongly down. So these allocations remain small. So if they were to fail, the overall impact of the portfolio would be super minimal. But if they succeed, we can add a little bit of additional returns, or just non-correlated, something in a different direction, to where if the rest of our portfolio is lagging behind, but maybe this manager or this sector, or for whatever reason, this is doing really well, can pad our losses a little bit, or just give us something with a little bit different directionality. So this will be well-managed funds, be maybe defensive management techniques, maybe hedged funds, maybe some derivative income funds, just interesting different stuff that might give us some interesting returns that aren't normal, that aren't index funds, that aren't just short-term bond funds, but maybe they represent really volatile or sensitive sectors. Like ESG funds are an interesting one. There are a lot of people who have really strong ESG preferences where we have to cover the whole portfolio. But if you believe in ESG as a sector that's going to expand, that's going to be something that will increase in the future, this might be a place that you put some of that in there. Just understand that until regulations really open up or tighten up for other sorts of energy, it's just going to kind of lag until things get efficient enough that they can compete. Because until green companies and other socially focused companies can compete with output and efficiency, the open market's going to choose the cheaper option 90% of the time. That's just what's going to happen. So those are very sensitive to regulations and other like tax policies and different stuff like that that incentivize those companies to exist. So very sensitive to economic climate in those things. Best performing managed funds might charge higher fees than most index funds. That's just going to normally be true. If you see things like large cap growth funds, or maybe like a T. Rowe Price capital appreciation fund, definitely way more expensive than an index fund. But if you go back over its history for the level of risk it takes on, it performs extremely well. Now, unfortunately, nobody can buy that anymore, only if you already have it. But it is a really good historically performing fund. So here you might have your managed stock and bond funds, derivative income funds like option strategies, emerging markets, new areas, maybe something like cannabis or any of these just new industries that have not really taken off yet, that are kind of sitting stagnant, that maybe one day will expand their market share and become large companies. So here's a couple different choices that you could have. Not that these are necessarily the best investments ever, but there are some things that fit into this example that you might look at and might represent other things that you'll be choosing. So PRWAX is T. Rowe Price's all-cap opportunities fund, which basically just means it's going to invest in stocks of all different sizes. It's not just large cap, not just small cap, mid cap. We're looking at any size, but they are basically actively looking for those individual companies. They are doing the management strategy. They're doing their own super complicated, however it is that they pick their stuff. But you'll notice that their fund is charging 81 basis points. That's nearly the same fee that you're going to pay an advisor to allocate your portfolio for you, depending on how many assets you have. So that's a really high fee. But if you go over and look at the historical performance, it tends to pay off. There will be some instances that it won't, but you really just want to, again, that's why we bias towards those low cost index funds, because we want to make sure we're getting that fee down. And then here we might add this on top and hope that the management team continues to do better in the future. Because also remember, just because a particular management team has done really well for the last 10 years, the next 10 years could be the worst of their career. You never really know because it changes. And something to pay attention to with managed funds is find out how recently the management has changed. Because it's possible that you could be buying into a fund that just had a management change. It's possible that like the main person who drove the returns retired and now is replaced with somebody else. So it's important to use something like Morningstar to look at these funds and see, okay, who's in charge? How long have they been here? How does that correlate with the returns over the last while? Has the strategy changed? All those sorts of different things. Next, we're looking at an income fund from PIMCO, which outperforms most multi-sector bond Morningstar category peers. So pretty much any other fund that is trying to do similar stuff that they are, this fund blows most of them out of the water. That doesn't necessarily mean that it does better returns than the market, but it does better than everybody else that's trying to. So this will be ticker PIMIX. And it's well regarded by analysts. It has done very well. And like I mentioned before, the bond market is sort of one that can be massaged a little better. That's where your active opportunities can really shine sometimes. But again, it charges that higher fee, 62 basis points. So if we have a large chunk of our portfolio in that, we might be getting really good yields, but we're paying a lot for that fee. So again, that's why we're biasing towards low-cost index funds. We don't want our whole portfolio to be costing 40, 50, 60 basis points, especially if you're already paying an advisor. So if you have an advisor and then they outsource all this work to all these super expensive funds, you're just going to be losing so much yield, so much return to those fees. So that's one thing that's kind of important. It's not horrible to have high-cost funds, but you don't want them to be so large that it's dragging so much of your capital away from you. This next one is one that has not performed particularly well over the last little while, especially with the hype of electronic vehicles kind of sliding recently. But IDRV, we call it iDrive, is iShares self-driving electric vehicle and technology ETF. It aims to position itself with companies investing in the future of automotives, and it charges a fee of 47 basis points. Now, recently it has not done super well, and usually that's because funds like this, with these sectors, there often tends to be one big company that's kind of leading the game, and a lot of these funds will be very heavily allocated in there. I don't remember what iDrive's particular top holdings are, but I just know that looking at it over the last year or two, its performance has been really, really not great. And electric vehicles just have not shown to be super profitable, very popular. Just generally, people don't really want to buy them. They depreciate like crazy. If you look on the secondhand market for electric vehicles, it's really kind of sad. Like especially you can see Teslas are really cheap from just a few years ago down to like $25,000 a lot of the times. And a lot of that is because of high maintenance fees and just the fact that you got to sit for an hour while your car charges at the gas station. Personally, I like being able to stop and fill up in 3 minutes and be on my way. Because if I need to drive to work in the morning, I can't sit and wait for an hour while my car charges. There's just a lot of reasons that they just have not quite fit into the market. A lot of things that kind of prevent people from getting super excited about that. So, but again, that's one of those things where it's a potential that maybe as technology starts to catch up, as things start to get better and it's more available to be adopted into the everyday life of customers, possibly a fund like that could do really well.
Make that a second. Remember, cannabis went way up in popularity and then crashed. This went way up in popularity and then it crashed. Leave the money to the venture capitalists on the first run and wait for it to drop, because sooner or later, electric cars, this has a bunch of car companies, Volkswagen, all kinds of different ones. Sooner or later, they'll get back their stride and it'll be a good investment. But we consider ourselves a second chance investor because we don't want to go through the door first, get shot first, right? Leave that to the venture capital.
So here is an interesting chart, which again will show us, it's very similar to some charts that we've looked at before, but this will show us small stocks, large stocks, long-term bonds, treasury bills, and inflation. You'll see the biggest return all the way up at the top, which is our darkest line. That's going to be our small stocks. One down from that is large stocks, then long-term government bonds, then treasury bills, and then inflation. And you can see this, you can see this giant crash from, I think it was that 1931 or something like that, where it just absolutely fell through the floor. But you notice that if you give yourself the proper amount of time, those more volatile investments end up on top. So this is one of those reasons that I really want to just re-emphasize why time is so important. Because you'll see, if we pick short periods of time, if I just say, for example, let's just go right here, in this little period of time right here, if I were to buy small stocks, I would not have done very well. You know, there's a significant drop there, and depending on when I sold out, I might be down a significant amount of value, and that's over maybe like a 5-year period. But if I stretch that to 10 years, it already looks better. 15 years, even better. 20 years, just the more time you give, more and more time that there is, the better those returns look on the more volatile investments. But then you can see if you want that short, super short period of time, maybe you just accidentally invested right before 2008 and it just completely crashed on you. Treasury bills would have done just fine. They would have hardly moved. But if you were in small stocks or large stocks, you would have seen a very significant decline. So again, it's kind of re-emphasizing why you want to be in stable things like treasury bills, government bonds for short-term holdings, because you don't want to be in that situation where you happen to buy right at the peak before the next correction and then not be able to withdraw your assets. That's why it's really important to have proper asset allocation.
Show the dollar left side category. What is the dollar road to? The top one is that 400 something?
$49,052.
$1 now.
Yeah.
But it's over like 8.
Yeah, that's from 1926 all the way to 2021.
If grandmother took away from small cap index, which they didn't exist, right? A small cap stock probably would have went bankrupt, right? But $1 in that index, if they have it back there for 49,000, and then $1 in the large cap index is only worth 11,000, right?
Mm-hmm.
And then they're more highly priced and more diversified than the bond fund. The dollar grows to 131, but we've seen bonds drop 40%, so it's not as big.
It's between the small cap and the large cap, what's the cap threshold?
I forget what the exact number is, but it's like a, do you remember what the cutoff for small, mid, and large cap stocks is for market capitalization?
But the trick answer is volatility is the main thing we're looking for. If you can find the cap, right?
Okay.
Cap, volatility is say 15%, go higher. The mid caps have an average volatility of 25%. And then the small caps have an average volatility of 35%. So the large caps are overpriced, but they're less volatile because they're less down. Did you find?
Yeah, so starting from the bottom up, micro cap, which are super tiny, will have a market value below 250 million. And then small cap to mid cap, or small cap is 250 million to 2 billion. Mid cap is 2 billion to 10 billion. Large cap is 10 billion to 200 billion, and mega cap is 200 billion and above. Yeah, and so
Anybody know why small caps tend to do well with trades?
They have a lot of loans.
They can get, yeah, because they have a hard time getting money because they're small companies, high risk. Interest rates go up, it's pretty expensive, but when rates fall, they now can expand. That's why you usually see them possibly do well when interest rates fall. They sometimes can do the opposite of large cap. S&P 500 is great, but it's crashed in 2022, right? Small caps, I don't remember, but might have not done as bad simply because they didn't have all the debt.
So our takeaway from all of this today is that creating your customized portfolio requires allocating properly for your needs, as well as diversifying between different funds and fund companies, asset types, and all those sorts of different things. So to address these needs and timeframes, we use our lateral and vertical integration concepts. So remember, laterally, we're looking for time. We're looking for our length of time. How long do we have? How long does that ruler go out? For vertical, we're looking for Like how many layers of those stocks do we have? Do we have our base that is really well diversified, really low cost? Do we have our extra things that we put on top for fun and for extra purposes, higher yields, different sectors, mobility, and all those sorts of things? Each portfolio will be unique to the person and the person's needs and risk tolerances. Point blank, period. You might have the same allocation as somebody else, but you might also have very different based on your specific needs. You might have a need for tax efficiency, for tax-free income. You might just not have any need for cash at all. You might not want yield, period, just growth. It all very much depends on what your needs and risk tolerances are. So it's very important to understand those and understand where you get them from. And that's something we'll end up talking about more later in later classes, is how we actually determine what your risk tolerances are and how to get there. But I like to talk about all of these concepts first, talk about how we're picking things, how you're even choosing this, because it makes it a little bit easier to understand how choosing a risk tolerance and objective is practically going to land, like where it's going to put you, what it's going to end up with you investing in. And it can kind of help you get an idea of looking at your current portfolio, getting an idea of where you stand right now, and then that maybe can help you get a better idea of where you're going to adjust once you're able to pick other things later. So with that, that brings us to the end of our class today. And I just want to open up in case anybody has any clarifying questions or anything they want to bring up before we go.